My name is Mary Ann Hubbard, and I am the controller here at Camco. I've been here approximately a year. I have 20 years of HOA experience dealing with associations in Nevada, California, Colorado, and Arizona. And this is just a little class to help you read your financial statements. So that's our little introduction. Oops. All right, so we're going to start with a little section on budget preparation. And when you're preparing the budget, you should always plan on your net income being zero. You're a nonprofit, every HOA is a nonprofit. You should never have income and you shouldn't have a loss. So your budget should always equal zero. You should budget a monthly reserve transfer to ensure that your association is adequately funded. And while adequately funded, there's no specific definition. It's kind of considered to be adequately funded if you're at least 70% of where you should be with the funding. The other thing to consider is that the budget needs to reflect potential contract and utility increases. And then the budget should also only be based on assessments. As a board, if you issue a late fee to a person and that person says, I'll pay you tomorrow if you waive the late fee, you're probably going to say, okay, because it's more important to get the assessment than the late fee money. And late fees and fines are meant as an enticement for people to pay. They're not meant to be a revenue source. And the budget should be adopted by the board approximately 3 months before the end of your fiscal year. So if your year ends in December, then that would be October, and you would adopt the budget, which means the board approves it. It is then sent to the homeowners 30 days prior to the end of the year, and a budget ratification meeting is held usually in November if you have a December year end. The only way homeowners can override the budget is by the majority of them showing up and voting against it. And as board members, I'm sure you know that very few people even show up to a budget ratification meeting. Okay, so the components of your financial package include a balance sheet. And a balance sheet is a snapshot of your financial position at that point in time. It tells you how much cash you have in the bank, how much money people owe you, the association, how much money the association owes to other people. And the income statement indicates your income and your expenses for a specific period of time. January, February, March, very specific period of time. The budget comparison has the same information as an income statement. However, it gives you the numbers that were budgeted so you can compare your actuals to what you actually budgeted. It lists a check register that lists payments for the month. It lists an expense register that says, these are the invoices that got approved during the month. These are the expenses we're going to recognize this month. It also includes an accounts receivable aging report, which shows how much money homeowners owe the association. The accounts payable aging report shows invoices that remain unpaid at the end of the month. And then at the end, there's bank statements and bank reconciliations. A little side note on the check register and the expense register. The check register is not necessarily your expenses for the month. So I take phone calls from board members that say, I added up all the checks we wrote and it doesn't equal my expenses for the month. Well, chances are it's not going to, because some of those payments on the check register may have been on your accounts payable aging report the month before. For example, maybe your landscaping bill for January wasn't paid at the end of January and it shows up on your aging report, but then at the end of January, but then in February, you paid it and it shows on your check register. And if perhaps you paid February landscaping in February, that will also show up on your check register, but your expense for the month will only be February landscaping. And the expense register, people compare sometimes the expense register to the check register, and those aren't necessarily the same things too. The expenses or invoices you entered, it doesn't mean they got paid during that month. So financial statements are prepared according to GAAP, which means income and expenses are reflected in the month they incur. For example, your assessments, let's say you have 100 associations and your assessment is $100 a month. Your income for your assessments is going to show $10,000. That's what you billed the homeowners. That's your income. That doesn't mean that's how much cash you collected. That's the income that you are due for the month. The same goes with, let's say you didn't get a utility bill for January. Well, you know you have a water bill, so a journal entry will be done to reflect an expense for that water bill, even though you don't have the water bill yet. And we mostly just focus on the larger items, contractual items like landscaping, management fee, and then we make sure that if you have a utility, if you have the utilities on your property that you're assessed, that you've shown expense every month, because you know every month you have a water bill or every month you have a power bill. So those are the main categories we stick with. The financial doesn't necessarily correspond to what is paid, and that's accrual accounting. And then as a board, the financials have to be reviewed every 100 days. So financial statement audits. All reviews and audits must be performed by an independent CPA. So you'll get the engagement letter. You'll sign it that says this is how much the audit firm is going to do the audit, and usually audit and taxes go together. That goes back, and then the management company provides them the information and they do the audit and the taxes. So if your annual budget is $45,000, and this mostly just focuses on assessments. If your annual budget is $45,000 or more, but less than $75,000, you have to have a review the year before you have a reserve study done. And the law requires that you have a reserve study every 5 years. So if you have a reserve study that's due in 2023 and your annual budget is between $45,000 and $75,000, you're going to have a review for 2022. If your annual budget is $75,000, but less than $150,000, you have to have a review every year. And a review is similar to an audit, it's just not quite as in-depth. And then if your budget is $150,000 or more, you have to have an audit every year. So this is the documents that are included in your financial statement. There's a balance sheet, income statement, budget comparison, check register, expense register, accounts receivable, aging, accounts payable aging, bank statements, and reconciliations. And then by law, we have to put a statement on here that says you are not using reserve funds to pay for operating expenses, because Nevada law says you can't do that. So operating expenses should be paid from the operating fund. Reserve expenses should be paid for from the reserve fund. If a bill accidentally gets paid from the wrong account, then we need to reimburse. All right, this is a balance sheet. So what the balance sheet does is it lists all the cash that you have in the bank in various accounts. It lists how much a homeowner owes you, how much various homeowners owe you, and it lists prepaid insurance. Now, the reason some associations have prepaid insurance is because, let's say you have a $12,000 premium annually and you pay it all at one time. Well, that means your actual expense every month is going to be $1,000, because if your insurance starts in January and you cancel the policy and go with a new carrier in March, you're going to get a refund for approximately $10,000. So that's kind of what prepaid insurance is that's the amount you have paid in advance for insurance. And then that amount from prepaid is expensed or listed as an expense every month on the income statement. Then you have prepaid assessments. This is for our owners that for some reason or another have prepaid their assessments. I've been asked this question numerous times. Why do homeowners do that? I don't know. Some people just do. A lot of people, especially if the assessment isn't very much, they'll pay the whole year at a time. And so the reason that's a liability is at any point in time, you may have to reimburse homeowners for the money that they've overpaid. Then accounts payable is the invoices that are not paid at the end of the month. So they show up on the accounts payable aging report. This deferred revenue is a new accounting practice where basically they said, let's say you transfer, your monthly reserve transfer is $10,000, but you didn't spend that $10,000. That $10,000 would then go into deferred revenue, because the assumption is for every dollar you put in reserve, at some point in time, that money has to be paid out towards a repair or a replacement. And so it's listed as a liability, or basically deferred revenue is money you are going to owe vendors at some future point in time to pay for reserve items. The same holds true for insurance claims. When you get an insurance claim check, you're going to have to pay vendors for that insurance work. And so that goes on the balance sheet similar to the deferred revenue, where it says, okay, we got a $12,000 check. And then when the repair work comes in, it's coded against that category, so it doesn't impact your income statement, and it shows the money you have left for the insurance claim. Next thing we have is an income statement. This lists the income you had for the month. So the assessments is the number of units times whatever your assessment is. The insurance, which in this case would have come from the prepaid, what you prepaid, and it lists all your expenses, and it comes down to a total net income of $19,1063. And if you want to that is also the number that you see right there as net income on your balance sheet. And then this, you have two income statements. You have one for the operating fund, one for the reserve fund. Then this is the income statement with the budget comparison. So you budgeted $15,990 for your monthly assessments, and that's the income that you're recognizing, $15,990. So this lists your actual expense versus what you budgeted for. I don't know how a lot of boards do this, but I encourage you to code invoices according to the expense. And an example is, let's say something happened and you have a $2,000 sprinkler repair that you didn't budget for. If I were a board member, I would code that $2,000 to sprinkler repair so that you have, next year, oh, I should probably throw a sprinkler repair line in my budget. But it completely depends on the board if that's the way you choose to do it. So this lists your month to date and your year to date. So one thing that happens is as you get more towards the end of the year, it becomes more critical maybe to look at the year to date numbers, because the budget is a guideline and you're kind of looking for how did our total budget compare to our total expenses. And so once you get closer to the end of the year to date number is more important in my opinion, because if you budgeted, let's say you budgeted for gate repair, and this is a perfect example, and this is only a January financial, and in January you had $888.18 against a budget of 25. Well, at the end of the year, that budget number is going to be $300. So then you'd actually be, and you had no other gate repair during the year, then that budget is a little bit closer to your expense, but you're still over budget. But the year-to-date actual versus the year-to-date budget becomes much more critical towards the end of your year. And once again, you will have, this is your total expense, and it lists your net income, which is the same as the other income statement. And you will have one for operating and one for reserve. Then we have the AP check register with detail. This is the checks that you wrote during the month or auto pays that came out of your bank account. So the checks start with a 1, the auto pays start with a 3. One thing you look for on the check register is, am I missing any checks? And if you find you're missing a check, reach out to your accountant, reach out to your manager. What happened to this check? This is the report I was talking about, that if you add up the expense numbers, it may not total what's on your income statement. So you have to be very careful, because technically, this Southwest Gas bill right here, that could have been for last month, but you paid it this month. So it won't necessarily tie to your income and expenses. This is your expense register. This is the invoices that got approved by the manager during the month. And with the exception of if a journal entry was done, let's say for insurance, you should be able to tie these amounts to your income statement. So these are invoices approved during the month, invoices paid during the month, and they are not necessarily the same thing. Then we have an aging report. This shows how much homeowners owe the association. Now, this association obviously does not have a huge delinquency issue by any stretch, but what you want to look for here is what is the balance? If they have been, let's say, they're very delinquent and you've turned them over to attorney, in this status column right here, it will state that. But when you're reviewing the aging and you see on here that Bruce Wayne owes you $10,000 and there's no status, you probably want to get with the manager and say, hey, we need to get this over to collections right away. And then we have, this is our accounts payable aging. This shows you invoices that are unpaid at the end of the year, or at the end of the month, I apologize. So these are invoices that at some point in time have shown up as an expense on your income statement, but they are not paid at the end of the month. And it lists it by bank account. So for example, you may have a dollar amount for the operating fund and a dollar amount for the reserve fund. And it just breaks it down by bank account, because when you're, when you're choosing invoices to pay, you have to select which bank account it's coming out of. And then lastly, we have the bank statements. You just want to review them and make sure that everything looks okay. Like obviously on this type of association, if I look down here and saw a check 100139 or something had cleared the bank for $20,000, I'd probably be like, oh, what is that $20,000? So these are the checks that come through the bank. And then these are your ACHs or invoices that are paid through Strong Room. These are physical checks that are cut. And then these are the other transactions, either auto pays or Strong Room payments. And then these are your lockbox deposits or any miscellaneous deposits. Mostly for associations, these are homeowner payments. Every once in a while you get an insurance check or something to reimburse the association or something like that. But for the most part, these are homeowner deposits. And then you get the canceled checks. And then you get the bank statement. Now this bank statement, this page tells you everything that cleared the bank during the month. So that just tells you that. And then this lists things that did not clear the bank during the month. So these were payments that were made, but they haven't cleared the bank yet. And you get one for the operating account, the reserve account, so investment accounts, typically CDs. You don't get monthly statements. They're just quarterly, semi-annual, annual, at maturity, or you have to request them. But you should always have an operating and a reserve bank statement and reconciliation. And this is the one for the reserve fund. So these are the items that cleared the bank. You did your reserve transfer from your operating to your reserve, and then you have your interest, and there's no outstanding items. And then your bank statement.